Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's late evening, Wednesday, March 18, 2015, and the title of today's audio blog is New Lows of Fed Idiocy and Cluelessness and the History's Most Poorly Choreographed Markets. Well, at least Ben Bernanke got one thing right in his pathetic world-destroying career, when at a dinner 3 months after Janet Yellen replaced him last year, for an hourly fee of $250,000 no less, he suggested to a private group of one-percenters that he doesn't expect the federal funds rate to be raised to its 4% average of the 52 years prior to his chairmanship in his lifetime. Not that I fault him for taking it to zero in 2008, as clearly the Fed chairman's job is to lengthen the Ponzi scheme that they created as long as possible. However, he actually believed it would work, and here we are today after 6 years of zero interest rates, nearly $4 trillion of overt QE, and who knows how much covert monetization, on the precipice of all-out global economic collapse. I'd say it's just a matter of time before he, like Maestro Greenspan, publicly attacks Janet Yellen's policies in a pathetic attempt to distance himself from the mess that he and Greenspan created. Only this time around, JY is simply expanding on Helicopter Ben's grand scheme, in true Ponzi scheme fashion, making things much worse. Sometimes I can only laugh, and at times stifle a cry as to how I was somehow chosen for my role of informing the world of the truth of monetary, economic, and financial matters. And that, of course, goes for David Schechtman, Bill Holter, and our merry band of financial rebels as well. Nothing I've encountered in my 44 years has been more stressful, and care of the cartel's relentless attacks, such as on 90 of the past 91 Sunday nights and 401 of the past 459 London pre-market opens. I have been forced to write and speak more than at any time in my career, partly because it's my job, partly to speak truth when few others will, and partly to handhold those in fear of the enigmatic movements of historically manipulated markets. Regarding the latter, when I went all into the precious metal sector in May 2002, it was Bill Murphy of GATA, Richard Russell of Dow Theory Letters, and Jim Sinclair that taught me about the cartel and the inevitability of gold and silver's reemergence on the global monetary scene. And thus I feel honored and privileged to do the same for you today, along with David Schechtman and Bill Holter, who have fought the same truth-seeking and disseminating journey. Today, at least, I'm here to report positive developments, even if the 6 weeks leading up to it were among the most mentally trying of my life. To wit, all the trends that caused precious metals to rally hard in January, i.e., plunging commodities, currencies, interest rates, and global economic data, have dramatically intensified since. And yet, care of the most intense market manipulation in the history of mankind, we have been subjected to a nasty sector smashing, while stocks have rebounded and bonds, other than those issued by Greece and shale oil producers, have soared. Of course, we don't own gold and silver as investments, but to save our earnings from the long-term catastrophic impact of fiat currency inflation, which is why I no longer own the speculative paper PM investments that can and have been utterly destroyed by the cartel, in lieu of real physical metal that cannot be bankrupted, defaulted, or replicated. Frankly, anyone that has continued to own material amounts of mining shares under the flawed assumption they are somehow proxies for gold and silver prices are unlikely to be listening to this audio blog, given the gargantuan losses I have warned of for the past 4 years. And for those holding physical metal with no intention of selling it until it is properly valued, good for you. Your gold and silver are trading well below the cost of production, in silver's case, way below, at a time when global demand is soaring and production is poised to collapse. Anyhow, today's audio blog is devoted to today's travesty of an FOMC statement, which frankly puts all such previous exercises to shame. I mean, when the Fed supposedly removed the words considerable time from its December 17th policy statement, my follow-up audio blog was titled Laughable FOMC Statement Sets New Central Bank Credibility Low. Next, in its January 28th statement, when it chose to ignore the crumbling economy, my audio blog was titled FOMC Lunacy Opens the Gates of Financial Hell. On February 24th, when Janet Yellen, in unprecedented fashion, revealed incremental monetary policy hints at her semi-annual Humphrey Hawkins congressional testimony, I taped the most unequivocally dovish FOMC statement in memory. And yet, I find myself nearly speechless to describe not only today's uber-dovish message and pathetically choreographed market priming and reaction, but the utter idiocy and cluelessness of the policy statement itself, which I must remind you is prepared by nearly 100 taxpayer-funded lackeys who spend 2 full days scribbling a few carefully crafted red lines into a 5-paragraph propaganda publication. Heading into this afternoon's FOMC statement, the Dow Jones propaganda average has fluctuated around the key round number of 18,000, not far from its all-time high of 18,300. That is, excluding inflation and the survivor bias effect of replacing dying companies like Citigroup, General Motors, Eastman Kodak, and AIG with better performers. Clearly, the market wants to decline, but with the exception of the 330-point decline last Tuesday, all declines were halted at the PPT's unofficial limit down level of 1.0%, followed by nonsensical surges the following day. In other words, the polar opposite of cartel rule number 1, i.e., all great precious metal days must be followed by horrible ones. As for bonds, despite all the hype about the supposed certainty of the word patient being removed, they have relentlessly surged from the lows generated when the BLS committed, for the name of my subsequent Audioblog, Manipulation Suicide, by publishing such a strong, though typically transparent NFP payroll report on March 6th. In fact, heading into this afternoon's FOMC statement, the benchmark 10-year Treasury yield had fallen from 2.26% at the March 6th high to 2.04%. Clearly, as I have shouted to the rooftops about, en route to the 1.64% low of 2 months ago, and inevitably Japan and Germany-like yields near zero. That is, until hyperinflation inevitably comes to town. As for the dollar index, it was hovering just under its 12-year high of 100, including 1.06 per euro, whilst the CRB commodity index was at its low of the year, within 1% of 2008's spike bottom low. And as for that other Achilles heel, crude oil prices, following yesterday afternoon's catastrophic API and inventory report and this morning's equally horrific EIA report, WTI was at a 6-year low of $42.50 per barrel, clearly en route to the 2008 low of $34 a barrel and perhaps significantly lower. As for precious metals, it's just not possible for them to have been more blatantly suppressed than in the past 6 weeks, as the very same factors that propelled their January rally, i.e. plunging commodities, currencies, economic data, and bond yields, accompanied by massive unprecedented central bank stimulus, have since intensified dramatically. And thus, an environment of extreme commodity deflation, currency inflation, and plunging economic data, supplemented, of course, by the potential collapse of the European Monetary Union. In other words, the optimal environment for owning precious metals, particularly at prices below their cost of production, in which no central bank in their right mind would even consider raising rates, much less giving a near-term timeline of such. Which is what I have said all along, and even Ben Bernanke, i.e. the money printer's money printer, admitted last May. Frankly, even I was shocked at the brazenness and blatancy of this week's propaganda campaign. Spearheaded by CNBC, of course, despite no one actually watching because its ratings have plunged to all-time lows, to convince the world of the so-called certainty of the Fed removing the word patient from its policy statement. I mean, I didn't title my February 25th audio blog the most unequivocally dovish FOMC statement ever flippantly, as there could be no mistaking Janet Yellen's Humphrey Hawkins message, let alone that since that message was delivered 3 weeks ago, every imaginable development, from plunging commodity prices to collapsing currencies, volatile stock markets, imploding U.S. economic data, and the accelerating Greek crisis, and the biggest global interest rate plunge of our lifetimes, validated such dovishness in spades. Not that this propaganda campaign was anywhere close to as long or intense as the late December telegraphing of the removal of considerable time, which, as you know, was simply replaced by patient. And the reason, of course, is that while the Fed is desperate to maintain the ruse that the economy is recovering, and thus that it will eventually raise rates and reduce its $4.5 trillion portfolio, the above factors made it very difficult for them to trumpet such silliness until the very last second. Frankly, it wasn't until this morning when, at the gym, I saw CNBC trumpeting the so-called certainty of the removal of patient, followed up by none other than Yahoo Finance, whose top story mirrored CNBC's blatantly scripted message. And this, whilst the most deflationary imaginable development, i.e. WTI crude plunging to nearly $42 per barrel, was scrolling across the bottom of CNBC's screen and the top of Yahoo Finance's website. I mean, talk about chutzpah. And last but not least, the Fed's puppy dog at the Wall Street Journal, John Hilsenrath, published the Fed's carefully choreographed, yet completely incomprehensible message that, quote, the Fed is about to inject uncertainty back into financial markets after spending years trying to calm investors' nerves with explicit assurances that interest rates would remain low. To which I can only respond with, huh? With the U.S. economy imploding and stocks and bonds trading at nosebleed.com-like valuations care of 6 years of ZERP, QE, and relentless PPT support, the Fed wants to inject uncertainty into the markets? I mean, as noted above, I thought it was manipulation suicide to publish such a ridiculously better-than-expected NFP report 2 weeks ago. But as for this act of stupidity, idiocy, and subterfuge, frankly, there just aren't words to describe it. Anyhow, as we headed into the 2 o'clock p.m. Eastern Standard Time statement, the Dow had just recovered half of its exactly 1.0% loss, as clearly the PPT's algos were blatantly priming the market for yet another dovish statement. Gold was up a few bucks, the 10-year yield was 2.04%, oil was $42.50 a barrel, and the dollar index around 99.5. And then the most moronic, idiotic policy statement of all time was unleashed, demonstrating not only how clueless the nation's top monetary gurus have become, but how rapidly their childish, ultra-transparent attempts to mask it have devolved. Honestly, you'd have to be a blithering idiot to not realize how dovish the Fed is, how clueless they are as to what has gone wrong, how blindingly wrong they have been in their forecasts, and how completely futile their printing presses have become. To wit, here's a summary of the material changes to the January 28th statement, notwithstanding the aforementioned February 24th Humphrey Hawkins testimony, when, in a nutshell, Whirly Bird Janet claimed, we have no intention of raising rates anytime soon, and before we'd even consider doing so, we'll first change the guidance in our policy statements. Even if we change such guidance, that doesn't necessarily mean we intend to raise rates anytime soon. To start, this is today, they changed information, quote, information received since the FOMC met in December suggests that economic activity has been expanding at a solid pace, to information received since the FOMC met in January suggests the economic growth has moderated somewhat. LOL, moderated somewhat? As in across-the-board data implosion, essentially mirroring that of the 2008-2009 crisis lows, and your own upwardly rigged model, assuming zero first-quarter GDP growth? Frankly, if it weren't for the fact that the tepid fourth-quarter growth rate of 2.1%, which will likely be downwardly revised no less, wasn't goosed 100% by accounting lies, I'd say moderated somewhat is the understatement of the century, and not just the 21st century, but the actual past century. Next up, not a change, but an equally brain-dead omission, as clearly the Fed is desperate to avoid admitting it was dead wrong about the impact of plunging oil prices. That is, they maintain verbatim the statement, quote, household spending is rising moderately and recent declines in energy prices have boosted household purchasing power, which frankly is the biggest, most bald-faced lie I have ever heard. I mean, what part of 3 straight months of negative retail sales growth, as well as negative personal consumption expenditures, suggests, quote, moderately rising household spending? Better yet, they also maintained, quote, business fixed investment is advancing, while the recovery in the housing sector remains slow. Well, I certainly agree with the latter lack of bullishness, except for one small teensy-weensy thing, i.e., there is no housing recovery. I mean, geez, home prices have been falling for months, housing starts and home sales have plunged, particularly in the key single-family home segment, and lumber prices have collapsed to multi-year lows at free-fall speed to boot. As for business fixed investment advancing, I'm equally incredulous, as everything from industrial production to durable goods to construction spending to factory orders have been reporting negative growth. And oh yeah, oil price spending, which is 1/3 of all S&P 500 capex. And then there's that deflation boogeyman again, as, quote, market-based measures of inflation have remained stable, was changed to, market-based measures of inflation have declined substantially in recent months. Yes, market-based measures certainly have, other than the stock market, which despite being the most deflation-sensitive asset class on the planet, is hovering near all-time highs, led no less by speculative small stocks, IPOs, and NASDAQ tech stocks that just surpassed the 2000 bubble top of 5,000. And as for non-market-based measures, it appears to me that the soaring cost of milk, meat, my health insurance, homeowners insurance, car registration, and just about every need versus want item aside from gasoline continues to soar. And boy, I just can't wait to enroll my 3-year-old in school. Although, thank God, the committee expects inflation to rise gradually toward 2% over the medium term as the labor market improves further and the transitory effects of lower energy prices and other factors dissipate. Yes, the ambiguous medium term I wrote of in yesterday's article, oil, Greece, and the Fed, which simply means the Fed has no intention of raising rates indefinitely, or at least until their cooked inflation figures surpass 2%, which, if you remember, was the other threshold event required for the Fed to raise rates. Yes, that and a 6.5% headline unemployment rate, which the Fed discontinued as a threshold event last year once it realized the real labor market wasn't reflected in this bogus statistic, which frankly is closer to 20 to 25% in reality. Irrespective, in true Fed fashion, they continue to lie through their teeth about, quote, improvements in the labor situation. Although when it comes to putting their printing press where their mouth is, i.e. raising rates, they remain as quiet as church mice. And as for said transitory impact of low oil prices and the equally ambiguous other factors, perhaps they're actually telling the truth. That is, if transitory means years and potentially decades. And by the way, considering that Janet Whirlybird-Janet is on record claiming low oil prices are a net positive for the economy, exactly why is she hoping this transitory period of low prices passes? And now for the granddaddy of pure unadulterated BS, depicting just how pathetic and transparent the Fed's efforts to feign recovery whilst making sure to make it crystal clear they don't really see a recovery and irrespective have not the slightest inclination to raise rates or for that matter do anything considered even mildly hawkish. Yes, the so-called removal of the word patient, just as considerable time was removed in December. To refresh your memories, here's what they said in December, which in a nutshell was, we're changing considerable time to patient, consistent with what we meant when we said considerable time. To wit, from December 17th's policy statement, quote, based on its current assessment, the committee judges that it can be patient in beginning to normalize the stance of monetary policy. The committee sees this guidance as consistent with its previous statement that it likely will be appropriate to maintain the 0.25% target range for the federal funds rate for a considerable time. In other words, they simply interchanged considerable time with patient, going to great pains to make sure readers knew the two meant the exact same thing. Well, if you thought that historically pathetic exercise in grade school wordsmithing was bad, take a gander at what they did this time, essentially repeating the same brain-dead game by changing January's language that, quote, based on the current assessment, the committee judges it can be patient in beginning to normalize the stance of monetary policy, to, consistent with the previous statement, the committee judges that an increase in the target range for the federal funds rate remains unlikely at the April FOMC meeting. In other words, they simply replaced the considerable time catchphrase with the patient buzzword in January, and now in March, which by the way was when Whirlybird-Janet suggested the first rate hike would occur following her December press conference, they got rid of all catchphrases and buzzwords entirely by simply saying they won't raise rates at the next meeting. I mean, just how stupid do they think the world is? Other than the morons in the MSM, of course, such as Reuters, which immediately issued a headline espousing, quote, Fed opens door for rate hike even as it downgrades economic outlook. First of all, exactly how did the Fed open the door for a rate hike? And about that reduced economic outlook, which typically doesn't coincide with imminent rate hikes, by the way, yes, the Fed lowered its 2015, 16, and even 2017 GDP estimates, which, by the way, have had as much historical accuracy as a blind man throwing darts. But don't worry, they continue to anticipate eternally declining headline unemployment rates. Really, I'm not making this stuff up. But even more ominously, the FOMC's average Fed funds rate assumptions plunged again, depicting just how clueless they are. To wit, since September, i.e. just 6 months ago, the average end of 2015 expectation for the Fed's funds rate has plunged from 1.4% to 0.6%. The year-end 2016 expectation from 2.9% to 1.9%, and LOL, the year-end 2017 estimate from 3.8% to 3.1%. Still, by the way, well below the 4+% long-term average Helicopter Ben noted above. As if the Fed, whose job is to eternally overestimate and cheerlead, can predict what will happen next month, let alone 3 years from now. Regarding the latter, I can still picture that moron Steve Leisman at CNBC, i.e. the television version of John Hilsenrath, showing an idiotic chart yesterday morning while I was on the stair climber at the gym of the expected trajectory of the Fed funds rate to, what do you know, 3.0% by the end of 2017. Again, we're talking about 3 years from now, when frankly, I bet that negative 3% rates are more likely. That is, if the Fed and current dying fiat Ponzi scheme still exists. Anyhow, after such idiocy and cluelessness was published for the entire world to see, let alone Whirlybird's pathetic press conference, which I didn't listen to as I had just eaten lunch, as I'm sure you can imagine, the Dow Jones propaganda average rocketed higher as the PPT ensures every single FOMC statement. Interest rates plunged as well, with the 10-year yield collapsing from 2.07% last night to a close of 1.90% today, which frankly I believe will be the last time we ever see a two-handle. That is, until, as noted above, hyperinflation comes to town. And don't forget the oil PPT, which, although being dead and buried, attempted a post-mortem spasm by ridiculously squeezing the shorts by taking WTI crude from $42.50 to more than $45 per barrel, as if anything the Fed said was even mildly bullish for oil, or for that matter, stocks. As I write on Wednesday night at roughly 11 p.m. Eastern Standard Time, oil is back down to $44 a barrel, and you could take it to the bank that in the very near future it will take out this morning's 6-year low of $42.50 per barrel en route to far lower levels. And then there's precious metals, which after having been slammed for 6 weeks, and heck, the nearly 2 years since the April 2013 closed-door meeting between Obama and the too-big-to-fail bank CEOs, before it launched the history's largest ever market manipulation and propaganda campaign, which of course surged higher after the uber dovish statement was released. That is, until the familiar cartel herald algorithm stopped gold at exactly the time-honored upside limit of exactly 2.0%. Rest assured, today's announcement will only increase the already globally record level of demand further, as clearly the inevitable Yellen reversal, i.e. when Whirlybird Janet is forced to admit the Fed's miscalculation and announce QE4, looms ever closer. And last but not least, there's the dollar index, which appears to have had its largest one-day plunge in history following the announcement, collapsing from 99.3 just before 2 o'clock p.m. to a low of 96.8. Was it due to the Fed's surprising everyone with unexpected dramatic dovishness? Not a chance in hell, as Whirlybird Janet's most unequivocally dovish FOMC statement yet at the February 24th Humphrey Hawkins hearing could not have been more dovish, let alone in light of the horrifying political, economic, and monetary events since. Was it due to euro short covering, even as the inevitable Grexit looms on the near-term horizon? Perhaps, but more likely the U.S. Exchange Stabilization Fund, i.e. the currency PPT, had planned all along to put in massive dollar sell orders, just as the oil PPT was on call to put in massive paper oil buy orders. Remember, the White House itself issued a veiled warning just last week that a surging dollar was creating a significant headwind to U.S. economic activity, which, by the way, is what I have been practically screaming for months, per my January 23rd article, The Most Ominous Quote of the Year. In other words, the so-called independent Fed was given marching orders to be uber dovish, which of course they desperately tried to balance with their 2-year propaganda campaign that the U.S. economy was recovering and thus that rate hikes were imminent. Which is just another reason why today's train wreck of a policy statement had more holes in it than a slab of Swiss cheese, and less tact and cunningness than your average 10-year-old. And why even Goldman Sachs, the government's willing partner and de facto overlord, admitted it was more dovish than expected. Unquestionably, today's hideously pathetic depiction of a clothless emperor dropped whatever remaining credibility the Fed still had, which, by the way, was solely based on its cowardly covert money printing and market manipulation, away completely. To believe that this game will last much longer without a hideous world-destroying accident occurring would be incredibly naive in our view, and to watch the collapse of history's largest Ponzi scheme idly without doing a thing to protect yourself would be pure insanity. And thus, if you decide to take action by buying or storing precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.